Coming up on Business Incorporated, the UN WTO initiative, Best Tourism Villages, returns for a second year as it establishes itself as the world's leading network focused on tourism for rural development. Banks in Zimbabwe allowed to set forex rates to tame black market. Plus, Central Bank of Egypt includes health workers. List of beneficiaries for its initiative for financing small enterprises establishments. Hello, welcome to the program. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday, starting in Africa. It's mostly negative. Here in Nigeria, the NGX index traded in the red, was down 0.06%. In Africa, the GSE was down again, just like yesterday, with a 0.39% retraction. Elsewhere, Egypt's EGX 30 had a massive drop, down over 2%. Meanwhile, Kenya closed down over 0.5% yesterday. And over to all the markets now. In the Middle East, it's different pictures. The indexes were mostly positive. United Arab Emirates, both the Dubai and Abu Dhabi index traded in different territories. Elsewhere in the region, the Qatari index added 1.54%, while Saudi Arabia notched up 0.44%. And now we head on to Europe. We have Chris Kober right there. Great to have you, Chris. Well, the fighting in Ukraine continues, and the Russian leadership is trying to navigate the financial implications of Western sanctions. It has now started paying Russian bondholders in rubles. Quite an interesting turn of events.
Well, because there seems to be little other way. Governments have frozen about half of Russia's foreign reserves. Sanctions have isolated its banking system, and some payments are being delayed by banks doing lengthy checks that they aren't breaching any restrictions, or these banks simply refuse to execute payment instructions, like in this case, JP Morgan, which had been processing payments on Russian bonds as a correspondent bank. Now, at the beginning of the week, the U.S. government declared that no dollar debt payments be made from Russian government accounts at U.S. financial institutions. Now, the Russian Finance Ministry says it has made about $650 million in interest payments to foreign debt holders in rubles, moving the money to a special account for foreigners within the National Settlement Depository, citing a local decree allowing foreign debt payments in local currency. However, neither of these securities involved allowed payment in rubles, according to the bond documents. Now, credit assessors, including Fitch Ratings and S&P Global, have said Russia will be considered in default if it doesn't pay payments in dollars within a 30-day grace period. So, holders of Russian euro or dollar-denominated bonds find themselves in limbo, and a Russian sovereign default is no longer an improbable event, according to financial experts.
All eyes on this bond payment, but there is hope for Moscow, though, because one EU country says it will accept bond payments in ruble. Which one is it?
Hungary said it didn't have problems to conduct business with Russia in ruble. In Hungary's case, that would be paying for Russian gas. The country's Prime Minister Viktor Orban saying if the Russians want rubles, we'll pay in rubles, highlighting that security of gas supply was his main concern. Now, stabilizing the Russian currency by making payments in ruble is something that, for example, the German and other European governments reject, but Hungary's position is significant here because by accommodating Moscow's demand, the government of Prime Minister Viktor Orban is not in line with the position of the EU. Mr. Orban has also shown reluctance to hit Russia with additional sanctions. However, these measures need to be agreed on by all 27 EU member states. Only in the face of atrocities allegedly committed by Russian forces in Ukraine, EU members have come around to targeting Russia's energy sector with punitive measures, something they've been shy to do so far, as the bloc depends heavily on Russian oil, gas, and coal. Now, with the Hungarian Prime Minister apparently unwilling to go down this path, it does put further sanction plans in question.
Quite interesting. Well, let's take a look at the markets now. We see global equities sank yesterday, amid further Western sanctions planned against Russia, growing expectations for more aggressive central bank monetary tightening. What's the word from the trading floor today?
It was indeed a mostly bleak day on global financial markets yesterday. Germany's blue chips index DAX lost around 2% amid concerns over the economic fallout of the war in Ukraine, particularly the talk about sanctioning parts of Russia's energy sector has investors concerned, as it is likely to have drastic and dramatic consequences for EU economies as well. And of course, historic high inflation in the United States has also been on investors' minds in trying to combat it. Several U.S. Federal Reserve officials supported raising interest rates by 0.5 percentage point in the future, according to minutes of the central bank's meeting last month. They showed deepening concern among policymakers that inflation had broadened through the economy. Now, despite the Fed's increasingly hawkish position, most European markets managed to stay in positive territory this morning, with the DAX gaining around 0.3% about an hour into Thursday's trading session.
All right, that's Chris Kober right there in Berlin. Thank you so much, Chris. Now let's head on to the UK. We see UK businesses feeling the impact of the war in Ukraine. We have Juliana right there. Great to have you, Juliana. So according to a survey from the Bank of England, nearly half of UK businesses expect Russia's invasion of Ukraine to hit their sales in the year ahead. Quite a bleak outlook.
It is quite a bleak outlook, Laddie. We had that confirmed this morning, didn't we, when Shell, the huge oil and gas titan, made it clear that they're going to be hit by $5 billion because of this Russian exit. And I think a month on, following the exodus of Western firms from Russia, they are starting to calculate the costs, and it is likely to be big. I think last week, a senior minister within the Duma, which is the Russian lower parliament, he suggested that any Western firm that pulled out of Russia should be hit with a 10-year ban on coming back into Russia, which is a little bit contradictory to what we've heard from our foreign minister here, Liz Truss, who suggested that perhaps if Russia does withdraw, then these sanctions will be lifted. But that's if Russia does allow these firms to come back. So I think now there does appear, having a look at the results from this Bank of England survey, that firms in Britain are starting to be a little bit anxious about the long-term cost. So, this isn't a temporary situation anymore. It does appear that it could be a long-term exit from Russia of at least 10 years. And let's not forget, it isn't just the big firms such as McDonald's, Jaguar Land Rover, Shell, BP. There are other smaller players that have decided to pull out. ASOS is one of them. That's the fast fashion online retailer. They mentioned a couple of days ago that they're expecting to take a £20 million hit from this Russia exit. And if you start to look at all of the other businesses, especially the small to medium-sized businesses, Laddie, which we know are the engine of any major economy, it could spell long-term problems ahead for the British economy.
It's so much to unpack there. But how are the markets looking today? We know they've been rattled since Wednesday.
Still rattled, I'm afraid. At intraday, the FTSE All-Shares down by 0.01%. The FTSE 100, that's down too by 0.07%. And the FTSE 250, the domestic market, that's up slightly by 0.19%. In the currencies market, the British pound is currently trading up against the US dollar by 0.10%, up against the euro by 0.11%, and also it's trading up against the Japanese yen by 0.20%. Worth mentioning that Shell, after they put that update to investors earlier this morning, they're one of the big fallers on the FTSE today, although Entain Entertainment, they're the gambling giant that own Ladbrokes and Coral, they did a pretty decent trading update and their shares are up. And then too, investors are reacting to Boris Johnson and Kwasi Kwarteng, the British Business Secretary's new energy strategy, which is kind of shifting away from our climate commitments in 2030 to try and find a long-term solution to tackling these surging bills, which are looking likely to rise yet again in September.
Yeah, the year of the squeeze. Thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
All right, now let's switch the conversation. Now we see international tourism has significantly recovered in January 2022, and 5 African destinations have been selected as part of the Nouvelle World Tourism Organization's Best Tourism Villages project. In total, 44 destinations were celebrated at the just held 24th UNWTO General Assembly in Madrid, Spain. Well, we have Elsa Grandcourt, Director, Regional Department for Africa, joining us today. Great to have you on the program.
To speak to Channels TV.
Great. So the best tourism villages, quite an interesting initiative there. Tell us about this initiative.
Well, as you rightly said, the Best Tourism Villages initiative was launched last year in 2021, and it was solely with the purpose of looking at the best examples of rural villages worldwide that harnesses the power of tourism to provide opportunities and also safeguard the communities as well as local traditions and heritage. Now, the initiative aimed at identifying villages taking innovative and transformative approach to tourism in rural villages, but also in line with the Sustainable Development Goals, and also to maximize the contribution of the sector to reducing regional inequalities and also to fight against rural depopulation. And the recognition is granted to outstanding examples of rural tourism destinations with recognized cultural and natural assets that preserve and promote rural and community-based values, products, as well as lifestyle that have a clear commitment to innovation and sustainability. Now, just to go a little bit more in the process itself, the selection of the best tourism villages is based on 9 core areas, and these will include cultural and natural resources, for example, promotion and conservation of cultural resources, the economic, social, and environmental sustainability of these villages, the tourism development and the value chain integration of it, as well as governance and prioritization of tourism, infrastructure, connectivity, health, safety, and security. So all applications are firstly received by us, but then there is an independent advisory board that does the selection. And you've rightly said at the beginning that we had a total of 44 villages that were awarded the recognition last year, of which I am happy to say that 6 of these villages come from 5 destinations in Africa, primarily Mauritius. They had 2 villages, and then 1 in each Rwanda, Kenya, Morocco, and Ethiopia. But let me also add the other component in this initiative is constituted of what we call the upgrade program. And this is where a number of villages that have not necessarily fully met the initial criteria to receive the recognition, these villages receive support from us, as well as the partners that work with us in improving the elements of the evaluation areas that where we've identified the gaps in the evaluation process. And in 2021, in addition to the 44 villages, we had 20 of these villages that were selected to join the upgrade program. And we still had 2 from the Africa region as well, Morocco and Rwanda. And the beauty of it is that all these 64 villages now form part of the Best Tourism Villages Network, where they are also able to exchange ideas and best practices, and of course, mentored by the independent partners that we work with that are specialized in the core areas I mentioned before.
Right. Quite interesting. And I would love to visit one of these villages at some point. Thank you so much, Alicia Grandcourt, Director, Regional Department for Africa. It was great having you on the program.
Thank you.
All right, so after the break, commodities market update is next. Do stay with us. This is Business Incorporated. Welcome back. You're still watching Business Incorporated. Let's drill down on the commodities market now. We'll be looking at chocolate, as the global chocolate industry is worth around $100 billion, which only $6 billion goes to cocoa producers. African countries, Ivory Coast and Ghana, produce 60% of global cocoa beans, making them top producers of the commodity, which is transformed into chocolate products. However, European countries such as Belgium, Germany, and Italy, who produce a negligible amount of cocoa beans, lead the pack by a long shot in chocolate production, accounting for more than 73% of global chocolate exports. Let's talk to Maiwa again, our analyst at Financial Derivatives Company. Great to have you, Maiwa.
Hello, Ladi. Good afternoon. Thank you for having me.
Good afternoon. Quite a disparity there, with producers and the exporters of chocolate. Why are cocoa producers, like Ghana and Ivory Coast, not taking advantage of this?
Well, like you rightly mentioned, right, the big money is in the production of chocolate, right, and other cocoa-based products, and not really in the planting and harvesting of cocoa beans, right? But I think that these countries actually are realizing this. If we actually look at what's been happening, just last year, the president of Ghana announced that they will stop shipping raw cocoa beans to Switzerland, and they will start processing more of cocoa beans locally. And then right now, about 30% of their cocoa beans are processed locally in Ghana. And then looking at other things, over the past decade, they have 5 times more processing facilities. In Ghana, for instance, in the last decade, there's been a growth in artisanal chocolate makers in Ghana. And then we're also seeing the government making strategic moves, bringing up policies to encourage the growth, encourage local processing of cocoa beans. The government of Ghana they created a free trade zone outside of Accra, where companies in this zone actually enjoy a tax breaks, 10-year duty-free on importation of parts for their equipment. And so these are steps in the right direction. This shows us that these countries are actually realizing that for them to actually get more from the cocoa industry, they need to move into the value chain, the vertical integration of cocoa beans. However, there are certain challenges that are limiting the growth of the processing plants in these nations. Number one, we have access to affordable finance. Infrastructure is number 2. Number 3, you have temperature. The temperature in these regions is very high, and then chocolate is temperature sensitive. You also have the issue of knowledge, lack of knowledge, and local talent. So that's also a problem. These are challenges that are facing processing facilities or the processing of cocoa beans in these regions. However, I think that the governments of these nations are aware of it, and they're taking the step in the right direction. And I think that in the next couple of years, we should see more growth in the vertical integration of cocoa beans in these nations.
Quite interesting, but it seems to be more of a symbol, of Valentine's Day in Nigeria. Is this part of a behavioral shift among young Africans?
Well, I think that it's not new, right? It's the older generation also share chocolates. It's not only the younger ones.
Right.
But generally, there has actually been an increase in the consumption of chocolate in emerging markets like Nigeria, right? And this can be largely attributed to the improvement in the economic growth and that leading to the increase in standard of living of people. Now people have a bit more to splurge on things like chocolate, and then also increase in urbanization, and also a shift. There's a possible shift in taste buds to more westernized taste, and this is mainly driven by the younger generation, right? So maybe you can say that the younger generation is also playing a part in this increase in consumption of chocolates in Nigeria.
Quite interesting, but some sources say that chocolate of the future may come out of bioreactors. There's been significant progress in development of synthetic chocolate in Europe. Well, if this actually comes to be, how would this impact cocoa producers? Doesn't seem good for them.
Well, I think the jury is still out on whether or not synthetic chocolate or plant-based beef and all of these things will become a staple in the near future. And also the timing of it is still jury's still out on that. But I think that we should look at more pressing issues, things like deforestation affecting climate change and child labor issues plaguing the cocoa industry, and how this is actually posing as a much larger threat in the current state to these nations, right? Already, the European Union is already making plans to actually stop the importation of cocoa because of its impact on harmful impact on human rights and the environment. And so this is even a more present threat to these nations, right? And then if this happens, the foreign exchange of these nations will be affected because, number one, Ivory Coast, cocoa is their major export revenue source rather. Then Ghana, cocoa is like the third largest revenue source. And then the foreign exchange earnings will be impacted if the EU, for instance, stops importing so much cocoa from them. And what this will mean for them is that they won't be able to service their debt. And then also they would have difficulty financing essential imports, right? So this is the impact it will have on these nations. For Nigeria, recently we started making more investments in the cocoa industry, trying to diversify our economy. I think that what this just tells us as a country is that while we're making it's a step in the right direction, we cannot afford to put all our eggs in one basket and go the way that we have gone with oil, right? While we should still invest in cocoa, we need to really, really diversify our revenue source, right? But generally, even for all these countries, it also goes back to what we said earlier about vertical integration. These countries need to make increased investments and make more steps in processing of cocoa beans in their nations, because that's where they would actually be making more money from.
Quite interesting, synthetic chocolate. All right, Mayowa, thank you so much. Always great to talk to you, analyst, financial derivatives company. All right, now, so let's move on. We see Zimbabwe is allowing banks to set their own rates for exchanging U.S. dollars in transactions up to $1,000 as it seeks to ease pressure on the weaker currency auctions and to tame a runaway parallel market. Lenders can now use a willing buyer, willing seller basis rather than being restricted to the official exchange rate for the local dollar. Now, the Zimbabwean unit is priced officially at $145 per US dollar, but trades at 260 Zimbabwean dollars in the parallel market. The move is an acknowledgement of pressure on the currency after previously rejected calls from industry to devalue the local unit and close the gap to the black market price. And the Central Bank of Egypt included doctors, physiotherapists, and dentists who are authorized by the Medical Syndicates Union to list for beneficiaries of its initiative for financing small enterprises and establishments. The CBE launched the initiative on the 11th of January 2016 with the objective of providing loans for the industrial sector with a declining 5% interest rate. The initiative also targets small businesses that are under construction, which also employ less than 200 individuals and have a business value of 50,000 Egyptian pounds up to and below 3 million Egyptian pounds for industrial projects and below 5 million Egyptian pounds for other sorts of projects. All right, that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.